Because my advice to the Fed, my advice, and who the hell am I to give anyone advice? But my advice to the Fed, I think we've been pretty steady on this so far for the past 2-3 years when it comes to getting in and out of the market based on the stupidity of the Fed and what they're going to do and doing the opposite of what they're saying. My advice, ignore this CPI report. I know it's hard to do, right? We all think short term, oh my God, inflation. No, it's going back higher. It's going back higher. It's an anomaly. Rentals are going down. This is based on data reported by Diana Olick. They're gone down. They're not going up as much. They were going up 4 times faster, and they've cut back. It takes a while for that to filter through the system when it comes to rentals. It takes a while, just like it takes a while for, as they thought, for rentals, it's usually a steady amount, and it doesn't go up by a lot or go down by a lot. If it does go up a lot, it's not crazy, right? That's why they constructed the CPI and put 30%, made 30% shelter. Now it's coming to bite them in the ass, because that's the biggest component. And yes, we saw food go higher, but energy came down. But if you're looking at rentals, okay, you can go to rentals, right? So let's look at the reasons why inflation's high. Rentals, which is coming down based on data today. This is a lagging indicator today. They're coming down, and they're going to come down even more sharply. The housing market it is done. It's done. If you look at the housing market, holy cow. You wanted like a screeching halt to a massive growth market? You just did it. You just did it. You're looking at the velocity of money, which I talk about in past podcasts. It's already crashing. That indicates money's coming out of the system. It indicates recessionary times. We're already at levels right now not seen since the Great Depression, and you want to continue to raise rates. You're looking at housing. I mean, just to put in perspective, mortgage rates are 3% in January. They're 6% today. What does that mean? The average home right now at $500,000, put 20% down, you're taking, a $400,000 mortgage out. Just on a $400,000 mortgage. The difference between 3% and 6% is a monthly payment that's $700. Monthly, not yearly, monthly. $8,400 a year right out of your pocket. You know how much money that is for most people? Simply because you didn't buy a house 9 months ago? The same house that you were looking at that you're like, oh, okay, well, let me just wait a little bit and see. And now, nothing. What's changed? 9 months ago. You know how much money? They put that in a calculator and go over 30 years and look at that amount. I mean, times at 8,400 times 30 years. Yeah, you're looking at hundreds of thousands of dollars in extra payments simply in a 9-month period because the Fed went nuts on rates at 6%. So 8,400, and that's, for regular middle class home. What about lower income levels? I mean, think about it. Now look at energy prices. Energy prices are coming down, which, by the way, people like, well, energy prices are going to go up. They're, the strategic oil reserve, they're taking so much out of it. And true. And energy you could see go high. But I'm going to tell you, energy is a good place. I think the stocks are going to do well. But I think energy prices stay around here. I mean, I think you're going to see them between 70 and 90, pretty much. Maybe they go higher. I still think oil is oil is a good sector to invest in. Oil has come down, and you notice how the stocks continue to go higher. I mean, you're going to see those profits. You're going to see earnings potential. It's one place that you'll see growth year over year, where you're not really seeing growth in earnings. If you look at earnings, they're down 4% year over year. If you strip out energy, that's big. Companies generate less earnings. That's the S&P 500 as a whole. Those earnings are down 4% year over year. If your earnings are down, what do you think that means with the job market? I mean, so these higher rates are resulting in consumers cutting back on spending. That results in less pricing power for companies, and that translates into what I just said, lower earnings, which are being lowered. Not only were earnings only down 4% year over year if you strip out energy, which is every other sector, 10 of the 11 sectors, but they're being lowered significantly into next quarter at one of the fastest rates in years, which is why, according to PricewaterhouseCoopers, PwC, they just came out with a recent survey. And it was, I looked at the details because sometimes surveys are like, well, we surveyed 5 people. And based on these results, the market's going to go down 97%, right? I mean, this is what they do, consulting. All right, so PwC, this is 700 companies, executives, like spread out, real survey. 50% of companies said they expect to lay off employees over the next couple of quarters. Look at Goldman today. Goldman laying off employees. was that Rent the Runway stock or whatever that is, cutting 25% of its staff. PVH, which is a power company, cutting Netflix, laying off 20% of its staff. Snap, 20% of its staff. Alibaba, 1/3 of its staff. Remax, 17% of its staff. Peloton, Robinhood, Spotify, Rivian, GameStop, Tesla. What about JP Morgan and 7-Eleven? Those are businesses that should be thriving. I mean, higher rates are good for banks. JP Morgan's laying off. 7-Eleven, 40% of their sales comes from gasoline. They're laying off. Everyone's laying off. And it's going to be almost every company because profits are going down. Which means what? What has the Fed been saying? We're not in a recession. We're going to redefine recession. It's not 2 quarters of negative GDP. No. Why? Because the labor market's strong. The labor market's strong and higher wages. So those 2 catalysts the Fed is citing as reasons they need to raise rates, or the reason why, hey, you know what? Our economy is still pretty strong. They're guaranteed 100% to get significantly weaker going forward. Guaranteed. But if you're looking at all those details, rentals coming down, companies losing pricing power, the housing market shut off, you throw in China and Europe already in a big recession, where's the growth coming from? The Fed significantly raising rates. How do you expect the job market to stay strong? Look, stop looking at data from the past and just do a little homework and use your freaking common sense. Listen to the companies. Listen to what they're saying. They're reporting. Listen to the conference calls. They're telling you exactly what's going on. Listen to their tone from this quarter compared to last quarter compared to the quarter before. 2 quarters ago, they're like, hey, we're still seeing... Last quarter, like, half of the companies are like, well, we're still weathering okay, but we're cautious. Now, look what they're saying. Different tone. Well, we're laying off employees. What does that tell you if they're laying off employees? It tells you business is not strong. They're seeing weaker demand across the board. It's the reason why technology companies are getting smoked today. You get more impacted from higher rates because they make all their money from spending, and consumers and businesses are going to spend a lot less if they're making less profits. Does it make sense? Did I lose you? Hopefully not. But just based on that, you're looking at this report. It's enough reason to ignore this data that came out for the CPI, which is going to make these guys go absolutely nuts in September, in a week and a half from now when they meet. They're going to go nuts. Oh my God, what do we do? We got to raise. Holy cow, we got to raise because we said it was transitory. We don't want to look like idiots on both sides. You're going to look like idiots on both sides. You're going to make a bigger mistake. But if that's not enough reason to ignore the report, just look at the inverted yield curve between the 2-year and 10-year. It's widening. It's widening as both of these yields are approaching their highest levels since the credit crisis. But the widening of that yield curve, it was negative, right? It's negative yield curve. Not only is this an extremely reliable recessionary indicator, right? When we see that, it tells us right now that what the Fed is doing, raising rates aggressively, it's not working. That's why it's widening. And that's what we have when the 2-year yield is much higher than the 10-year yield, right? Inverted yield curve. And it's widening. It widened today because it's telling you that the Fed, it thinks the Fed's going to raise rates, and it shouldn't. Stop raising rates. That's the indicator right there. So one more cut, fine. 75 basis point, fine. But focus on reducing your balance sheet, less on raising rates, because it's clearly not working. It is working, but it's not working as fast as you think because you're looking at past data. But just look at what happened. Look at the velocity of money. Look at the money coming out of the system. Let's look at restaurants. Listen to Walmart. Listen to Target. Look at the inventory levels. And these guys are like hoping and praying that we're going to see a bounce back and inflation is going to come down. They could sell us inventory at higher prices. Just wait. If you're a consumer, just wait till Black Friday. You're going to buy a 70-inch TV and they're going to give you one for free. That's how much inventory these guys have in the balance sheets. And that came from everyone. Kohl's, Best Buy, across the board, retailers. It's why they're cutting staff. You don't cut employees when business is good and strong. And you're seeing every single day that comes out, more and more companies are laying off employees. And the more employees there are in the market, that's when you're going to see that wage. Right now, you could command, not even now, but for the past 2 years post-COVID, it's hard to get employees. Why? Because the best people could sit home and they're still getting paid by the government. They don't care, whatever. But now there's going to be a lot of smart people on the market. So your existing employees who want those raises, good luck. No, there's really good people out in the market right now. Sorry, that's when you're going to see wages come down. That's what happens. But you're looking at a Fed where one more cut's okay, but right now with the tone, if they come out the same tone, they go 75 basis points, even a full point higher, and they raise rates, and then come out and say, we're going to 4%, 4.5%, man, look out. Look out. Because raising rates is not just going to really hurt the U.S. economy, and we'll be okay, right? We'll see stocks come down, home prices come down, but it's going to absolutely destroy the global markets, which is saddled with debt. All because why? Because you're getting information and data that is not reliable. It's not reliable. You can't tell me shelter should be 30% of the CPI, and the reason why you did that, there's a reason why inflation, again, it gave you the data that stayed below 3%. Almost every single year, barely broke through 3% almost every single year since the mid-90s. Why? Because, hey, and look at it. Read what I told you and look it up. You're going to see how they kept revising it and revising it and revising it. Where they won't include the costs of homeowners who are renting that actually pay the electric. And I mean, it's fascinating the way they twist it around. These are all algorithms that they're using. These are all algorithms that work. And algorithms work until they don't. And then you get the housing crisis. The CPI doesn't work. It's not telling you, it's not giving you a good depiction of what's going on with the economy right now. And if you just sat on your hands, one more rate hike and sat on your hands, you'll see it. You're going to see it. It's all out there for you to see. Just look under the hood a little bit. But if you're going to aggressively do this, look out. You're going to see food and rent, see prices fall likely sharply in these areas in the months ahead. As the labor market, wage growth shits the bed. Housing, the biggest driver of growth of the past few years, is basically a non-factor. And the Fed removed this growth component by raising rates so quickly, but immediately removed that component. I mean, how much stuff is bought when you get a new house? And that fuels the economy. Turned off. 2 seconds. But right now, after this number, you need to be careful here. That's why the market is selling off sharply. We're already in a global recession right now.